Hello and welcome to Investors Hangout. This weekly interaction to help you learn and understand savings and investment issues is brought to you by Aditya Birla Sun Life Mutual Fund and Value Research. Now, with SEBI allowing mutual funds to invest overseas, let's learn in today's episode from Dhirendra Kumar how you can tap into this global opportunity through mutual funds. Welcome, Dhirendra.
Thank you.
So, to start with, can you please explain why should one invest internationally?
Why invest abroad? Simply because your job is here, your investments are here. So we diversify. We diversify to reduce our risk and for a promise which is otherwise not available to Indians. You look at our phone. We look at the you use alphabets, Google. You use Gmail, you use Facebook, you use Instagram, but you can't own them if you don't invest in these funds. So that is one thing. Investing in a promising sector or promising set of companies which are global leaders, and when you invest in an Indian fund, you don't get exposure to that. So they are just equally promising or very promising businesses and opportunity. Second is to diversify. So diversification and great opportunities.
Okay. Now, why invest through a mutual fund?
Indian investors have been permitted to invest abroad. You can open an account and you can remit $200,000 every year and you can invest in a portfolio. It's complicated. You have to take a risk with the broker. You have to buy it on your own. You can buy a mutual fund abroad. Are you buying it in a legitimate form? What happens if the the broker goes bankrupt? When you invest in a mutual fund, you have an overlay of safety of the Indian regulations that here is a regulated entity which is investing either in a fund of fund or investing in those stocks himself directly. And you have all the safety net available in the regulations and the simplicity of taxation. There is absolutely no restriction of $200,000 every year or any such thing. That's one. Second is actively managed nice vehicles available. Third is that I find that the taxation has become simpler and easier and without any complication, because if the moment you invest abroad, you have to go through a very complicated filing. You have to make sure that all your reports and everything is, and you don't have, unlike Indian investments where everything gets aggregated and you get, when you invest in India, either through a broker or in a mutual fund, and any mutual fund, you are able to aggregate your statement from NSDL, CDSL, the two depository participants, or CAMS and Carvey through the MF Central online facility. So every year you can get your capital gain statement, this statement, that statement. By investing in such a fund, you are able to benefit from that. You are getting exposure there and you are getting the safety of Indian framework.
Okay. Now, for someone wanting to invest abroad through mutual funds, if you could suggest how to do it, are there any funds that one should look out for?
There are many funds, and Indian funds were permitted to invest abroad for a long time ago, and there were restrictions, and some funds are hitting that ceiling. Some funds, the rules are that the whole mutual fund industry put together can invest $7 billion, and they did hit the ceiling, and off late, because of some depreciation in value or some withdrawal, some window is available. Each AMC on his own can invest no more than $1 billion. So there is a entity-wide, there's a limit for the entity. There's a overall limit for the whole industry. And for investing in ETFs, there's a ceiling of $1 billion. And individual companies have a ceiling, the maximum that they can raise money or invest abroad in an ETF is $300 million. So these are the restrictions. And there are still about 25-30 funds which are available, which are taking money. And you have this interesting investment avenue. Besides this, there are 5-6 other avenues, which you can buy, because these ETFs, they have hit the ceiling. But those ETFs are listed in Indian market. If you want to buy those ETFs, and if because ETFs are not getting invested abroad today, it has already been invested, it is owned by somebody, and if you want to buy it, you are buying it in the market and somebody is selling it. So no new unit is getting created. So in the market, you can buy some of these ETFs which are listed, and you can buy them even now, though they cannot create new units.
All right, well, that's about investing internationally through mutual funds. Now there's a viewer's question. Tarak Shah says, please suggest a fund that can be used for SWP at the age of 60.
There is no rule. And a lot of people come to me with expectation that I will prescribe them and the problem will be solved. No, this is your problem and you have to solve it. Think through it. And I'll tell you how to think about it. Assuming that, you have 1 crore rupee lying in your bank account and you want to invest, and from there you want to mount your SWP. I'm making this 1 crore rupee simply for ease of calculation. It is no indication of, that you must have or not have or any such thing. Just for ease of my mental calculation, that you have 1 crore rupee, you need 6 lakh rupees a year, which is 50,000 rupees a month, which is a I would say a moderate expectation, not very aggressive and not very nominal, not very low. So for withdrawing 6 lakh rupees from 1 crore rupees investment, I think an aggressive hybrid fund will also be good, because it will generate on an average over a 10-15 year period, it will generate anywhere between 9 to 12, 13, 14. Some years it will do exceptionally well. Some years it will do less. And on an average, that is the kind of expectation I will have. And when you take out 6%, you leave the rest for it to accumulate and actually support higher income requirement in few years from now. If your scale of investment is very high and your withdrawal rate is going to be very low, if you're going to need just 2%, you can well be into small caps, and it doesn't matter, because all you have to do is your withdrawal rate should not be of a scale whereby if the market is in the dumps, you should not be eating into your capital. So it entirely depends on what is your withdrawal requirement, what is your income requirement from investment. If the income requirement is very small in relation to your capital, then it could be in very aggressive allocation and investment. If it is moderate, something like 5%, 6%, 7%, then I would say 1/3 into fixed income and 2/3 into equity. And if it is going to be very stretched, 8% kind of thing, then you will have to get all the more conservative. So this is a paradox. The less you need, the more you can generate, because you can't take higher risk.
All right. Well, hope, Tarak, you've got your answer there. That's all we have for you in today's episode. Keep watching the space for more information. If you like the show, do subscribe to our YouTube channel. Take care. Bye for now.